What's up, everybody, and welcome back to the channel. I'm Stephen Barnhill, joined today by my business partner, Deborah Bly, and we have a very special guest, Mr. Phillip Warrick from Next Level Real Estate Coaching. He's going to talk about a hot topic right now in the creative financing space, and that's subject to financing. So, Phillip, just give us a little introduction, if you can, about yourself, what you do, and if you could just explain to us what subject to financing is, I think that's a perfect place to start.
Okay, awesome. Well, thanks for having me on the show, Deb. And
love it.
Stephen,
Yeah.
I appreciate the opportunity to be here and to share with your audience what I've been doing for over 21 years. And, subject to essentially is a form of creative finance. Buying houses as a real estate investor is what I do. And I went full-time as a full-time real estate entrepreneur in 2003. And 2003 is actually the first time that I bought a house subject to. In 2003, just to let y'all know, I was only 23 years old, right? So I was a couple years after getting started.
So no, you don't have to wait until you're, and you probably had not saved up $1 million to be doing this.
That's a good point. And that's a great, when I was a 17-year-old senior in high school, I remember getting the idea. I was like, hey, when I go to college, I want to buy a house and rent rooms out to my friends, and that would essentially pay for the house and I could live there for free. And I remember asking my dad, I was like, Dad, what do I need to do to buy a house when I go to college? And he's like, well, son, you probably need to save up a 20% down payment and, build up your credit, and then you can do that. That sounds like a great idea.
So I love that you're saying that, because that is frequently, even when we talk to people today that are just not investors, but just buying like regular houses.
Right.
That thought is in there. It's like, you got to save up all this money. In reality, you don't. So
that's right.
You're spot on.
That's right.
What I really want you to cover too, like subject twos are a big deal right now.
Yep.
Why are subject twos so hot right now? As they were doable several years back as well, but right now they're really a hot commodity.
Yeah, they really are, and it's going to be based on the interest rates, right? So, where can you get an interest rate right now at 3% or 4%, or like the last deal that we purchased, we actually picked up a house at 2.75%. This was just a couple of months ago, a house in LaPorte, right? And so it's a way to not only help sellers that need to sell or want to sell, but these sellers, they were going through a divorce, they were behind on payments, they were about to be foreclosed on, and the house was in need of repairs, right? So all of these things were against them being able to sell the house the traditional way through a real estate investor, right? They basically owed more than what the market would bear. But that 2.75% interest rate loan, that's what we were buying, right? Solving their need. It helped them because instead of paying off their mortgage, we actually reinstated their mortgage and we keep their payments current. Every month that we make a payment on time, it's building their credit back up, right? So now when their divorce is behind them and their problems are behind them a year or two down the road, their credit's going to be back in a position where they can start utilizing their credit.
So I'm going to tell you right now, I completely understand what you're saying, Phillip, but I'm going to tell you, they probably don't. Like, that probably just went over, unless you've been doing this probably went over your head. So explain like the whole process. So it's not like you're going and you're buying a house on the market and you're going to go buy it now. You're not paying cash. You're going to get a loan. You're not going to the lender to get a 6.4% interest rate based on what they are today, right? Mm-hmm. You're actually taking over the existing loan that the current homeowners have in place.
And that's basically, in a nutshell, what subject to is, right? You're coming in and assuming the loan that's in place, keeping everything in place, and you're getting the benefit of a good interest rate, and at the same time, you're helping a client who is in distress. Exactly. Is that right?
100%. And it's called a silent assumption because we're not going to the bank and getting their approval to assume their loan. Okay. Right? It's legal in all 50 states, right?
Let's just, before we go charging ahead, let's break it down. So when you have somebody that has a home, they have a loan on it, they're not going to outright sell the house and cash out their loan, so pay their loan off. They have two ways of that loan transferring over to the buyer. One is an assumption, which will be approved by the lender.
Correct.
And then the other one is the subject to, which is what we're discussing now. So what some of you realize, and some of you don't realize it at all, when you go and you get a loan on a house, there is a due on sale clause. And what that means to you guys is, if you go and you get a loan today, It may be assumable, it may not be assumable, but in the note that you sign, there is a clause in there that says, should you sell this house, this note becomes due.
That's right.
That's something else you'll need to explain to them.
Sure. Yeah. So what Deb is talking about is that every mortgage has a clause in it that says if title is transferred without us being paid off, we have the right. It's not the obligation, it's not illegal, but we have the right to call the loan due. Correct. For transferring title. And that's what she's talking about. So that's something that we need to be aware of, right? And it's every time we close, we disclose it to our sellers. The title companies that we work with are familiar with it as well. And we can do strategies that we put in place to help prevent that from happening. The reality is a lender is a lender. They don't want to own real estate. They want to receive income from a real estate note, right? And so as long as those payments are being made, they have no reason to call the loan due. And They don't have somebody in the bank's department going and checking title every day or every month or every year to see did title transfer, right? So it's not common, but it can happen. In the 22 years that I've been doing sub-2 deals, I've had a loan called due 2 times, and neither one of them became a problem, right? We were able to work it out with the bank or figure out what to do, to get out of that situation.
Yeah.
Right?
Now, can you walk us through kind of when you're looking at a potential deal, who might be the right fit for a sub-2 type of transaction? What metrics are you looking for? I know you mentioned interest rates being low. Right now we're in an environment where they're above 6%. If you can get something, as you said, 2.75, 3, 4, somewhere in that range, it's attractive. But what is the sort of ideal situation that you're looking for to where you as an investor would say, that's a great subject to opportunity?
Yeah, so the interest rates are very important, right? And as a real estate investor, one of the things that we look at when we're buying houses, what are the 5 profit centers for us as an investor, right? One is to buy the house a little bit below market. Like real estate investors don't pay full price. The thing is with sub-2, a lot of times we can pay full price. Right? Because the second profit center we're looking for is cash flow. If I can buy this property and hold on to it as a rental, can I make more in rental income than the underlying debt? So the lower that mortgage payment is, the lower the interest rate is, the more likely it's going to fit that buy box.
Sure.
For a seller, like what makes sense for a seller, like I said a minute ago, a lot of times they're behind on payments. They don't have enough time to sell and take 3 to 6 months to sell the traditional way because there's a foreclosure coming up, right?
Right.
Maybe they don't have enough equity to pay all the 6% commissions and closing costs and everything. Maybe they don't have the funds to fix the property up, right? So we buy the properties as is, where they don't have to worry about making those repairs. And a lot of times they're, in a situation. They're either in a distress situation, like a divorce, job transfer, vacant house, behind on payments, or a house that's in a distress situation. And we can help solve and fill that need for them. A lot of times real estate agents might be representing a seller where there's not enough equity to even pay the 6% commissions, right? So low equity deals can still be a solution. In the example that I gave, the real estate agent still got paid as well, right? And we bought a house in Baytown where the real estate agent brought us the lead. There wasn't enough equity. The buyers that they had lined up backed out after the inspection period, but they had already committed to the next house. And they needed this closing to be able to close on their next house, or they were going to lose that too. But we were able to still pay them the cash that they needed and the real estate agent as well.
Yeah.
Right? So it's situational, right? We're in it to help every party.
And I think that's a really important thing for agents to know, because I'll give you a personal story. I listed a home about a year ago, and this was a situation where the family was just looking to downsize a little bit, had some adult children that moved out and whatnot. And they moved to a home not far from here, and they purchased that. And then their home that they were living in prior, they had bought only in 2021. So there wasn't a whole lot of equity, a whole lot of meat on the bone as far as equity is concerned. And we were running up against a situation where the interest rates were 7-8% at this current time. And the offers that were coming in were going to require them to bring cash to the closing table. Now, my email inbox got inundated with these subject to offers. And truthfully, I didn't know much about it at the time. I was presenting them to my clients, as I'm required to do every offer that comes in. The same question kept coming up with the clients. If it has to stay in our name, we're not interested because it's going to hurt our debt to income ratio. We're not going to be able to finance a car. It's going to, put a damper on a lot of things we're trying to do as a family. So can you speak to that? Because we ended up selling the house. The story ended well. It wasn't the price that they were hoping to get for it. Right. However, it wasn't where they had to come to the closing table with an obscene amount of money. In that situation, educate me as an agent how I can better give that conversation to the next client I have that is in a similar situation.
Yeah, very important. And, one of the things that we need to make sure of when you're getting these offers, that you vet the person making the offer. A lot of times it's wholesalers that are out there making these offers, trying to find those deals and then bring them to somebody like me, right? Wholesalers are people that typically don't have the funds, right, to be able to do the deals themselves. They go find deals and they bring them to an investor that has the capital or access to capital to get those done. So you want to make sure that the end buyer, for one, is who you're talking to, and that's who you're approving and vetting to make sure that they know what they're doing.
Yeah.
Right. That's one thing. But to fix the debt to income problem, we close every deal at a title company. So there is a HUD settlement statement. There's a whole set of closing documents. That's one way. It will affect their debt to income ratio for a little bit, right? It might be 6 months, it might be 12 months. But once we have a track record and a history of us making the mortgage payment for them and the set of closing costs, then a good educated lender can use that as proof that we're the ones making it. They're no longer responsible for servicing that debt.
To that point, I just want to say too, if you're in a situation where you're not making your payments because your house is looking to go into foreclosure because you have a house that in a traditional market at the traditional what today interest rates are, and that's why it's not selling, right?
Correct.
Your credit's not in good shape right now, but the fact of the matter is 6 months to 12 months later, when you're all caught up, because you guys also catch up on their arrearage of their payments.
Correct. Absolutely.
So when you're all caught up on the arrearage of payments, and now you're consistently making, I'm going to guarantee you're making your payments on time.
100%. Let's set it up on automatic.
So now you have a history of making those timely payments on time. As a matter of fact, instead of it being a credit issue down the road, it's actually the opposite of that because you moved forward with these steps. You're actually a year down the road in a better position.
Well, it certainly doesn't hurt or doesn't help if you have a foreclosure on your record as far as credit scores are concerned. So, this if you have to take a 6 to 12 month hold off period on when you want to purchase that next car or whatever the case may be, it certainly beats being foreclosed on.
Right. And to your point, some of these sellers, they're not selling it because they're behind on payments. They're selling it because there's not enough equity in the home, right? Or they would have to write a check at the closing table. So we buy a lot of houses too that are not behind on payments. Not every one of them is in that situation, right? And so it's okay for them. And most of the time people like that, they have good credit and they have a strong income and they can have 2 mortgages on their, right? But the point is once we're making the payments and we can prove that those payments are coming from us, a good lender that's versed in these kind of things can help them.
They're going to get a collection of the back payments that are being made, source where they're coming from, and that is going to come off of their debt.
Yeah, it's almost similar to like if they had the house rented out, right? They have the rental income. In the beginning, they can't count all of that rental income until there's a 12-month history. Right, They might give mark off 50% of that debt to income, from that mortgage until we've been paying it for a year or 2.
Yeah.
And that was the case with my clients. They just, they were not behind on the payments. They just weren't enjoying the double mortgage payment every month and the holding costs of keeping 2 houses up, and the thought of coming to the closing table with cash. The next question I have for you is, once you do these subject to deals, what do you do thereafter? Is it like you do these subject to deals with the goal of fixing the home up and putting a renter in there? Do you take some of them, fix it up and flip them? What's sort of the strategy once you ascertain a property?
So one of my favorite questions to any real estate question is it depends.
Yeah.
So it really does. We do everything from buy, fix, and flip to buy and hold with long-term rentals. We're doing stuff with Section 8 with housing as well to try to provide affordable housing. We have 47 listings on Airbnb right now as a short-term rental. We're also looking into doing like pad split, like assisted living type things or rooms to rent, things like that, right? So what can I do as a real estate investor to also serve the community, right? To serve a need for people with affordable housing. And even with our short-term rental business. They're fully furnished houses that we put on Airbnb, even houses in the suburbs around here. But that's also a business that creates a lot of jobs and employment for our team, for our cleaning ladies. It gives them a good living wage job and opportunity to work with us and to work with our team. Handymen, all of the trades that we work with as well. But typically these are investment properties that we plan on holding, for 5, 10, 15 years. And that's the thing, like our profit is made in the long term. It's not made right now. This isn't today money for us. Right. This is wealth creation. It's a way for us to serve the community and change people's lives and to provide jobs and affordable housing for people.
Sure. Yeah. And the Section 8 is very, when I was getting started in real estate, I can't tell you how many people that I helped with rentals that were like, I need Section 8. And the reality is when you start to look for those particular clients, there's really not a whole lot. And of what's available, there's really nothing that's great as far as options are concerned. So,
correct.
And I think that's a really important thing that you brought up, serving the community and doing things like that, because let's be honest, like real estate investors sometimes get a bad rap. Like, oh, these guys are going in and buying up all the houses. The little man can't get an offer accepted. And then they're just, raising the rents at obscene rates and stuff like that. But in reality, we need real estate investors. We need people like yourself in the market to do those things that you're talking about. Short-term rentals. Houston's a medical city. There's a lot of travel nursing that goes on. I can't tell you how many people call into this office wanting a rental for 2 months, wanting a rental for 3 months. And, there's just hardly anything available. So I think it's important that you bring that up.
Yeah.
Yeah. And we're getting calls right now, from the fire that was in Deer Park with people that have their houses burnt down and they need a place to stay during the insurance claim. And these people need a furnished house. It's more realistic for a family to move into a house for 3 to 6 months while their house is
as opposed to a
hotel.
Hotel.
Three hotel rooms. So.
Yeah.
Can you back up real quick, because I know, and you had mentioned this earlier, and when you say, oh my gosh, what happens when I do this, and they do call the note due. So you've been doing this for 22 years,
right.
And you said there's been twice where the lender came and called the note due. First of all, why did they call the note due? And then second of all, you said you resolved it. Everything was fine and good and dandy and you move forward. Obviously, you have a lot of money tied up into this house right now.
Mm-hmm.
So you're not likely to walk away from that. How did you resolve it?
Sure. So the first one was a house in Pasadena that we had bought sub to, and they were behind on payments. And at that point where we took over, as you guys may or may not know, when you're behind on payments, you end up in the loss mitigation department of the bank. Somebody gets assigned to that loan, and that's the person that's reaching out to the seller to try to get them reinstated or whatnot, right? And so in that time frame, they started calling, and they got my number because I always send in an authorization to release information. Mm-hmm. And that's when they found out, oh, you actually purchased the property subject to. Yes, we did. Well, that's not allowed. And I said, I understand, right? And I just kept making payments. They never threatened. Every now and then I would get a call from that loss mitigation. How's it going? How's everything? Oh, everything's fine. We've got the house rented and payments are being made. And we still own that house subject to this day. And this was like 15 years ago, mm-hmm. right? So it nothing happened. It was just kind of like a threat that was there. Mm-hmm. More recently,
when you say there were 2 instances, you're just talking of one of those instances was a phone call.
Correct.
Okay, big deal.
Yeah, never got anything official, like anything, but I was literally on her phone. My phone number is who they were calling moving forward to service that loan instead of the original seller. And the more recent one was a house that we actually bought from a real estate investor. And this house was actually purchased with an investor loan, from one of these DSCR lenders, right? So they're a little bit more strict.
Say DSCR.
Right? Debt service coverage ratio.
Yeah, so I get it, but they don't know what DS, it's like when you go to any trade thing and they're using all these acronyms to explain DSCR.
Yeah, so DSCR is a debt service coverage ratio loan. Essentially what that means, instead of using your debt to income ratio, they're using the income from the property to qualify. It's an investment strategy that real estate investors use to buy rental properties. And another advantage to that is those loans don't end up on your personal credit, so you can accumulate more properties by using a DSCR lender. And so that's the situation. It was a DSCR lender, and they found out that we had actually purchased the property, subject to, and they said, hey, you're in violation. And they were really actually firm about it. They were calling the loan due. They were given the attorney notices and things like that. So we were able to reach out to them, and essentially we were able to deed the property back to the original seller, which is an investor, right? So we're on a friendly relationship. We're never behind on payments. Everything's been fine. And so we were able to deed that back to them, and now we have an agreement that we're basically partners on that deal. So I'm still controlling the property and everything. The bank said, yeah, that's perfectly fine. So just deed it back to the original seller's name, and we're no big deal.
So in that case, that still ended up being a good deal for you, and And in actuality, that ended up being a good deal for the previous owners. So they came in as partners with you.
Yeah.
Well, you have to think about the mortgage servicing company. Their goal is to not spend a bunch of money on a foreclosure or whatever legal proceedings they have to do to call the note. If the payments are coming in every month, it would make sense that they don't care who's putting that money forward to those payments. It's just a matter of, are they getting paid, which is why I'm sure you've done dozens or more of these deals, and only 2 of them have ever had any sort of issue. And that's
so we're going to break that down. So every 11 years, you may have something that comes up that's an issue.
That's a good point.
There you go.
And it's been hundreds of deals, right?
Hundreds of deals, yeah. So let me ask you, because this is the question that kept coming up with my clients when we were getting these subject to offers. What happens if the person who takes over this loan sub 2 stops making payments? How do I protect myself from that? What sort of measures do you put in? Because I know most of the subject to investors don't use the typical 1 to 4 family purchase contract that we use as agents. You have your own set of agreements that you use. So what are some stipulations in that agreement where the person who's yielding the property to you sub 2 is protected?
There's a couple different scenarios, and we'll talk about the people that are behind on payments. Me as a buyer, I'm protecting myself more from them than they are from me. Right. And essentially, as a sub 2 for them, they don't have a repercussion to come back to me to take the property back, as an example. Okay. For somebody that has great credit and they're in the situation where they just didn't have enough equity and things like that, what we do is we do kind of what's called a mirror wrap, right? So we can put a clause in there that says, hey, if we ever get behind on payments, you can take the property back. They can foreclose, or we'll just sign it back over to them, right? So making sure that those kind of terminologies are in the paperwork. We can use a tract contract. And we use tract contracts all the time. We'll just have to add our sub 2 disclosures, which brings all of this information to light, right? Explains everything to them, the risks and how to get back out of that situation if it were to come. But the short answer is basically they could foreclose on us and they can take the property back.
Okay.
Which that would be in the case that we're not making payments, right? If we're not doing what we said. And a minute ago you mentioned like, hey, we have a capital investment in this deal. Right. So we're putting up money to reinstate the loan, to renovate the property, right? So we'd be hard pressed to actually quit making payments and lose that investment for us or for our partners.
Exactly.
Well, you have to think if that did happen, if I'm the person that has that original note, you've invested money in catching up on my loan. Potentially, you've certainly invested money on probably doing some rehab, and you've made some kind of a down payment, cash that you've given them, right?
Correct.
The agent
if they get that, if they have to foreclose on you, that's not necessarily been a horrible deal for them.
Right. Don't stay awake at night wishing that I fell, because they'll be in a better position if they take the house back.
Yeah, exactly. So they probably would stay awake at night, not worrying if you're going to make the payments, but worrying for you not to make the payments so that they could recapture their equity. Right.
That's a good one. Yeah.
My question that I have for you is like, looking towards people that want to get into this sort of stuff. Now, you mentioned that there's a lot of wholesalers, there's a lot of people that really just don't have the capital behind them to make this happen. They understand enough about subject to think they can put some deals together, but in reality, they probably aren't in good standing to be able to do that. Yeah. Let's say, for example, I decide I want to be a subject to investor like yourself. What would be the steps in what chronological order to get to where you are right now and be not just somebody who's making subject to offers, but be a serious, legitimate subject to investor?
Perfect. And to make sure that you don't put a seller at risk for these scenarios, right? You want to make sure, first of all, it starts here, right? It starts with getting educated and learning from people who are actually out there doing this business, that are vetted, that have a responsible and or have the work ethic that it takes, right? And having access to or having your own capital behind you, because if for some reason one of our houses becomes vacant and we have to make the payments without income, we can do that. We can support that, right? So making sure that they have the capital and access to capital to be able to do that, to be able to do it with the right title companies, to make sure that everything's done above board, everybody's legally protected, and the right paperwork to protect you as a buyer, the seller as a seller, the real estate agent, that everything's fully disclosed.
What sort of burn rate would you suggest that somebody have? Like, how much capital in the bank if they're going to do their first subject to property on, let's say, a $250,000 house that's got an $1,800 a month or $1,700 a month mortgage note?
Yeah, and I think that's going to be, dependent on the person themselves. Like if you follow a Dave Ramsey principle, you're not even going to buy a house.
You're not going to do subject to,
yeah. Right? You know what I mean? But I mean, having I guess a 3 to 6 month cushion, to be able to cover some vacancies and things like that, and then. And just like with any rental property, you want to have some money set aside for repairs and maintenance and things like that. And it's going to, it'll be dependent on the monthly cost of that house, and some reserves for repairs and things that come up. So
I have to love that you brought up Dave Ramsey, because there's a lot of stuff that he says that I like, but then there's other things I think. Don't buy a house. Don't put yourself in debt. Just keep paying rent.
Yeah.
I mean, that doesn't make sense. So, I mean, I love that you brought up, so from a consumer perspective, here are some options for them. I also love, I think we're talking to two different people right now. We're talking to the potential consumer that says, hey, this may be an option for me. We're talking to the potential person that says, hey, I may be interested in finding out more about this to get involved in this kind of investment. I also think we're speaking to the real estate agent, and that's somebody I really want to focus on speaking to as well. As a real estate agent, this is what I see and what I find, and you may find similar. There are a lot of agents out there that have clients that could really benefit from a program like this. They're getting the offers, they don't understand them, they don't understand how to explain it to their clients. So I think in our professional world, educating agents that are out there, what this is all about, where they can go to, what they should be looking for so that they can better help their clients is really an important factor.
Yeah, 100%.
And so last thing I have for you is, can you just let everybody know where, let's say, for example, you're somebody who's listening to this who may be a couple months behind on their payments in the Houston area, that thinks that this might be a solution for them when they didn't think they had one. Also agents like myself, who a couple months ago, I didn't know you, otherwise I would have introduced you to my clients and maybe we could have made something happen. So where can people find you? Obviously, you're always looking for deals, and how do people get in contact with you?
Yeah, that's a great question. And for sellers, the people that need to sell or want to sell, TexasHomeSavers.com is the name of my company and my website.
And we'll put that link in the description, guys, to his website.
Yeah, they can find me there. For real estate agents, I do a Zoom every Monday called Power Mondays, and it's a creative finance Zoom, right? So it's free to attend, right? And we usually meet, we'll have 10, 15, 20 people, depending on who shows up, and we can evaluate deals and look at deals together. Or if you want to just reach out to me, if you have a seller who you think would benefit from these services, then just reach out and we can have a conversation, look over that opportunity together. I believe the best way is to be represented. If you're a seller and you need to sell, to have somebody like the Bly team represent you, right? To be able to explain these types of strategies and these types of offers to you, and then they can bring it to me if you need a buyer in that situation, right? And at the same time, we do some coaching and mentoring programs and things like that. And I know Deb and I have some plans to do some more coaching and teaching and be able to bring this to agents and people that need it. But
yeah, and I love that, Phillip, and I do agree with you. I think for the consumer out there there are so many different options. This is definitely I think a great option for somebody that needs this option. But there are so many different options. I believe too, as a consumer, your best option is just to get with somebody that knows the various options that are out there for you. If this is the best option for you, we're definitely going to refer them and steer them in your direction. But sometimes there's other options too that may be a better fit.
Yeah.
And Deb, do you want to talk about the investor workshop? I know you alluded to that a little bit, but we're going to be doing some coaching here. For those of you that happen to be in the Houston metro area, or that don't mind traveling, we do have some investor stuff coming up. So can you tell a little bit about that?
Yeah, as a matter of fact, this next coming Saturday, what is that, Chris? October the 5th?
Yep.
He's going to look at his calendar. Is it October 5th?
I believe so.
At least you know. At least you know where you're supposed to be. I don't know where I'm supposed to be, but yeah, October the 5th. Actually, Phillip is going to be coming. We're going to be actually doing an investor workshop here in our office the first Saturday of every month moving forward at 11 o'clock. Chances are you're seeing this video after the fact, and that's okay. You can still reach out to us if you have any questions. However, that being said, just put the first Saturday of the month on your calendar, 11 o'clock, because aside from what Phillip is presenting us, I think we've made it abundantly clear there's so many different strategies and options and things to do out there. We're going to just try and address every first Saturday of the month those different options, or kind of go a little bit deeper into the different things.
Cool. Well, Phillip, thank you so much for your time today. I really appreciate you coming and educating our audience, and I think it was a very valuable conversation.
You're welcome. I'm excited to work with you guys, and I appreciate you having me on the show today.
We're really grateful to have you there, and very grateful, because these are the things we want to try and get out there. It educates everybody in our community. Thanks. Appreciate it much.
Thank you, guys.
Guys, thanks so much for listening to this episode. And if you're interested in subject to or any sort of creative financing, reach out to us. We'll put some links in the description below. And of course, make sure you hit that like button and subscribe to the channel for more real estate information. Have a great day. Cool.
Cool.
Thanks, man. It was really good stuff.
Yeah, really good stuff. I
Thank you.
really appreciate it. That's awesome.